Wall Street has an excuse for extending a rally in November. Investors are regaining their appetite for risk. The long-awaited official data on the private employment and the jobless rate has been released, adding another argument in favor of the completion of the Fed's rate hikes. Despite optimistic signals in the pre-market, there are factors which could put pressure on the stocks later today. For a start, let's sum up the results of yesterday's New York session. The three benchmark stock indexes jumped by almost 2% each. The S&P 500 logged the strongest performance. The index has been climbing for 4 sessions straight. Yesterday, it closed with the biggest intraday gain since April. The S&P 500 leapt by 1.89% to close at 4,317 points, in line with the optimistic forecast of our analysts. Besides, the index closed above its 200-day moving average for the first time since October 24. The index opened today on an optimistic note like others. Futures on the stock indexes inched up by 0.2 and 0.5% in the New York pre-market. The S&P 500 is expected to test resistance at 4,370 points, which is unlikely to be broken today. The lower border of the intraday corridor is seen between 4,310 and 4,320 points. On Thursday, the stock market was in an elevated mood in the light of the Fed's policy decision and Powell's dovish signals. The market perceived his comments as the sign that the central bank decided to terminate the cycle of rate hikes. As a result, yields of long-term U.S. Treasuries went sharply down, bolstering sentiment on Wall Street. The U.S. Labor Department reported yesterday that the number of initial unemployment claims increased moderately last week. In this context, all 11 main sectors in the S&P 500 gained ground. Energy stocks and real estate stocks sensitive to the Fed's interest rates came to the fore with the biggest gains of more than 3%. Qualcomm shares jumped by 5.8% after the chipmaker presented a stronger than expected sales and profit forecast for the first quarter. PayPal shares surged by 6.6%. Apple shares closed with a 2% increase. However, the shares fell by 3% in the New York pre-market because Apple's sales forecast for the holiday quarter defined Wall Street expectations. Bearing in mind the market capitalization of the iPhone manufacturer, it could challenge the stock indexes. Today, the pleasant aftertaste from the Fed's policy decision was complemented by the fresh NONFARM payrolls. Despite troubles related to strikes, the data props up the risk-on mood. Hiring in the U.S. Slowed down in October more than expected due to the strikes orchestrated by the United Auto Workers Union against the Detroit-based car manufacturer. The U.S. public and private sectors, excluding farm employment, created 150,000 jobs last month, and the figure is almost twice lower than the downwardly revised 297,000 jobs in September and below the consensus of 180,000. Payrolls in October were also below the average monthly increase of 258,000 over the previous 12 months, but remain well above the benchmark 70 and 100,000 per month. The jobless rate in the United States inched up to 3.9% in October from 3.8% in September, whereas the consensus had suggested a flat reading, and the latest score is the highest reading since January 2022. The average wage increased by 0.2% an uptick higher from a 0.3% rise in September. Average hourly earnings climbed by 4.1% in the last 2 months, the smallest growth since June 2021, after an upwardly revised increase of 4.3% in September and slightly above the expected 4% growth. The labor market data were certainly affected by strikes, and still the report summons expectations that the Fed Reserve has ended the cycle of rate hikes. Importantly, the picture was not complete by the time of recording this video, so optimism on Wall Street is still facing a challenge. The US services PMIs are yet to come, and some Fed policymakers are due to make their comments following the Fed's meeting. Vice Chair for Supervision Michelle Barr and Minneapolis Fed President Neil Kashkari are to speak tonight. While the stock market is enjoying a tailwind, the currency market is extending its anti-dollar campaign. Major currency pairs grew by nearly 1% against the greenback on Friday in light of the NONFARM payrolls. The US dollar index slipped by 0.8% to trade at 105.20 in the New York pre-market. The instrument is expected to trade sideways. The index is unlikely to fall below 105 points. If it happens, it will rebound. The least realistic scenario is that the index might recover to 105.50. In fact, the US dollar index reached the lowest level in more than 6 weeks. It's on a track to close the week with a weekly loss of more than 1%. The greenback is vulnerable to falling yields of US Treasuries. Yields of 10-year Treasuries retraced after they had reached a 3-week high of 4.25%. Yields of the benchmark Treasuries are on the way to the steepest weekly fall since March. The Canadian dollar is enjoying the greenback's weakness. The loonie is one of the main beneficiaries of the US dollar's fall. The USD CAD pair skidded to 1.3661 before the opening bell, 0.51% down. If the US dollar remains under pressure, the currency pair is expected to decline to 1.3640. Alternatively, the instrument might rise to 1.3720. The domestic reports showed today that the Canadian economy added fewer than expected jobs in October. The unemployment rate grew to 5.7%, the highest level in 21 months. The jobless rate increased from 5.5% in the previous months and surpassed the consensus of a 5.6% growth. The fresh reading is the highest since January 2022. And this state of affairs matches the warning by the Bank of Canada that its aggressive monetary tightening dragged down economic growth and enabled soft hiring. The Canadian economy created 17,500 jobs, weaker than the expected 22,500. On top of that, the average wage growth lost momentum. Average hourly earnings for permanent employees have increased by 5% since October 2022, compared with a 5.3% year-over-year increase in September. A weaker than expected jobs report will fuel expectations that the Bank of Canada may stop raising interest rates, especially after data this week showed the economy likely fell into a shallow recession in the third quarter. Despite solid fundamentals for optimism about risky assets, the crypto market gave a muted response to the US NONFARM payrolls. Bitcoin is trading lower after a rapid rally. The number one crypto traded at 34,500. In the New York pre-market, 1.1% down. As for the intraday forecast, the bulls are clinging to the level of $34,500. If they fail to defend it, the next support is expected at 34,100 and $33,890. The alternative scenario is the second attempt to overcome and settle above 35,500. even though FTX founder Sam Bankman-Fried was found guilty on a late Thursday of stealing from clients in one of the largest financial frauds in history. Market optimism is still undermined by spotty reports of auctions of the US Securities and Exchange Commission. The regulator is not going to give up. Under such conditions, it's too early to predict a steady rally. Our team of analysts strives to simplify your trading, providing you with the accurate market reviews. Your feedback is appreciated. We wish you profitable trading and see you online next week.